Picture this. A war, political instability, or trade disputes thousands of miles away could actually cancel your property insurance back home. Sounds far-fetched? Not at all. Today, we'll dive deep into the hidden ways global politics reshape the insurance industry, redefining how risk is measured and how policies are written. Welcome to Insurance World TV, where we break down the complex world of insurance and make it simple for you. Today, we dive into a fascinating and timely topic: geopolitical risk and its effects in the insurance market. Think about this. What happens when political instability, trade wars, or even armed conflict in one country shakes up the insurance market halfway across the world? From rising premiums to canceled policies, and even entire industries being reclassified as high risk, the ripple effects are far-reaching. In this episode, we'll unpack how shifting global power dynamics are forcing insurers to rethink risk assessment, adjust policy frameworks, and prepare for challenges that cross borders. Stay with us, because this is one conversation that reveals just how interconnected our world of risk truly is. Topic 1. Understanding geopolitical risks. Let's start with the basics. What exactly is geopolitical risk? Geopolitical risk refers to the uncertainty and financial impact that arise from political, economic, or security events around the world. These can be wars, trade disputes, sanctions, terrorism, political instability, or even sudden changes in government policies. In short, geopolitical risk is about how politics and conflict influence financial stability. Insurance, being the backbone of risk management, feels the impact first. Topic 2. Real-world examples of geopolitical events. Now, let's look at a few examples to bring this home. Global examples.
Example 1.
The Russia-Ukraine War. The Russia-Ukraine War disrupted global energy and food markets, leading to higher insurance costs for shipping, aviation, and even property in regions far from the conflict.
Example 2.
U.S.-China trade tensions. U.S.-China trade tensions created ripple effects for global supply chains, forcing insurers to reevaluate risks tied to manufacturing, exports, and shipping routes. Example 3. Expanded reciprocal tariff landscape. In 2025, the U.S. imposed sweeping tariffs, ranging from 10% to 50%, on key partners like India, Brazil, China, Mexico, and Canada, as well as on countries importing Venezuelan oil. African countries, including Kenya, were not spared either. These moves massively disrupted trade flows, increased costs, and introduced new layers of uncertainty for insurers. Example 4. Terror attacks. Terror attacks like 9/11 completely reshaped how insurers cover aviation and large infrastructure projects. Closer to home, here in Africa, geopolitical risks are no less significant. Number 1. Political instability and election-related violence. The 2007 to 2008 post-election violence in Kenya caused massive property damage, disrupted businesses, and led to increased political risk premiums in insurance contracts. Terrorism and insurgency. Al-Shabaab's terrorism activities in Somalia and Kenya disrupt businesses and complicate property and travel insurance. In Nigeria, repeated insurgent attacks by Boko Haram on oil facilities increased both the cost and complexity of insuring energy projects. Even sudden government policy changes, like tax reforms or restrictions on imports, can affect how insurers calculate risk for businesses. Topic 3. How geopolitical risks are reshaping insurance. Have you ever wondered how a conflict in one corner of the world could affect the insurance on your home or business right here at home? That's the power of geopolitical risk, a factor that's reshaping how insurers assess and price risk today. Geopolitics isn't just news headlines, it directly reshapes the risks we face every day. First, economic and trade disruption. Conflicts, sanctions, and tariffs can slow supply chains, delay shipments, and raise costs. Think of the 2025 U.S. tariffs on India, Brazil, and China. They didn't just affect trade, they changed insurance risk exposures worldwide. Second, market volatility and inflation. Political tensions spike commodity prices, currency swings, and financial uncertainty, forcing insurers to adjust premiums and investment strategies. Third, property and infrastructure risks. Wars, civil unrest, and terrorism directly damage assets, leading to higher claims. The Russia-Ukraine war, for example, sent industrial and commercial insurance claims soaring globally. Fourth, cyber and technological risks. State-sponsored attacks, intellectual property theft, and tech competition make supply chains more vulnerable and force insurers to rethink digital coverage. Fifth, regulatory and policy uncertainty. Sudden changes in government rules or tariffs can create coverage gaps. That's why political risk insurance is now essential in volatile regions. Finally, compound and emerging risks. Geopolitical events often intersect with climate change, migration, or pandemics, creating complex risks that traditional models can't predict, pushing insurers to innovate with solutions like parametric insurance. In short, geopolitics transforms risk from a local, predictable issue into a global, interconnected challenge. And in this world, insurers and you must adapt fast. Topic 4. How the insurance market responds to geopolitical events. Now that we've seen how geopolitics reshapes risk, the big question is, how does the insurance market react? Insurers are not just passive observers. They're constantly recalibrating to survive in this volatile environment. Here are some of the strategies the insurance industry uses to manage the impact of geopolitical events.
1.
Dynamic premium adjustments. The first and most visible response is higher premiums. When global risks rise, whether from war, sanctions, or tariffs, insurers adjust pricing to reflect that uncertainty. For businesses, that means the cost of coverage for shipping, property, or cyber insurance can climb almost overnight.
2.
Stricter exclusions. Insurers are also rewriting policy frameworks. Clauses that once felt rare, like war exclusions or government action exclusions, are now appearing more frequently. For example, many cyber policies now exclude state-sponsored attacks, leaving businesses exposed unless they buy specialized add-ons. 3. Capacity constraints. In highly volatile regions, insurers may simply withdraw capacity altogether. This means certain risks, like marine coverage in conflict zones or political violence in unstable countries, can become almost uninsurable without government-backed schemes or reinsurance support.
4.
Reinsurance reshuffling. Global reinsurers, the insurers of insurers, also play a huge role. If reinsurers pull back from a risk category, Local insurers have no choice but to tighten their terms, raise prices, or exit that line of business. This ripple effect ensures that a conflict in one corner of the world can impact premiums in another.
5.
Capital flight and innovation. On the flip side, some insurers see opportunity. Capital moves away from unstable markets into safer ones, while innovative products like parametric insurance or advanced political risk covers emerge to fill the gaps left by traditional policies. 6. The rise of parametric insurance. Here's where innovation comes in. Traditional insurance relies on assessing past losses to predict future ones, but that model is breaking down. Parametric insurance offers a different approach. Payouts are triggered by specific measurable events, like a port closure lasting 30 days, a commodity price spike, or a climate migration threshold. This makes it possible to cover risks that were previously considered uninsurable, such as prolonged trade wars, sudden sanctions, or even climate-driven population shifts. In short, the insurance market reacts by pricing risk higher, limiting coverage, and searching for new models to stay relevant in a world where yesterday's assumptions no longer hold. Topic 5. Staying ahead: how businesses and individuals can navigate geopolitical impacts. Understanding geopolitical risk is one thing, but navigating it effectively is another. So, what can businesses and individuals do to stay ahead in this unpredictable world? Proactive risk mitigation. For companies, insurance is just one part of the puzzle. Businesses can diversify supply chains, secure alternative energy sources, implement robust cybersecurity measures, and establish contingency plans for political instability. The goal is to reduce exposure before a claim ever arises. Personal finance in a volatile world. Individuals aren't immune either. Rising inflation, trade disruptions, or sudden tariffs can impact everyday costs, savings, and investments. Maintaining emergency funds, diversifying assets, and staying informed about global developments are essential strategies to weather these ripple effects. The future of insurance. The insurance industry itself is evolving rapidly. Expect more dynamic premium models, wider adoption of parametric policies, and specialized products for emerging risks. As geopolitical and environmental volatility grows, insurers and policyholders alike must stay agile, informed, and ready to adapt. In short, navigating the unknown requires a combination of foresight, flexibility, and strategic planning, whether you're running a business or managing personal finances. Geopolitical risk and its impact on insurance. A quick summary. Geopolitical risk isn't just a distant headline. It affects businesses, individuals, and the insurance industry worldwide. From trade wars and sanctions to regional conflicts and political instability, these events ripple across economies, supply chains, and markets. For example, the U.S. has imposed tariffs ranging from 10% to 50% on major trading partners like India, Brazil, China, Canada, Mexico, and countries importing Venezuelan oil, disruptions that immediately impact costs, insurance premiums, and underwriting processes. For insurers, this means navigating surging replacement costs, policy ambiguities, and the need to adjust premiums dynamically. Traditional risk models are no longer enough. Parametric insurance and specialized products are emerging to address risks that defy conventional assessment, from climate-driven instability to trade interruptions. Businesses can stay ahead by diversifying supply chains, securing alternative energy sources, strengthening cybersecurity, and creating contingency plans for political instability. Individuals can protect themselves by maintaining emergency funds, diversifying assets, and staying informed about global developments. In short, geopolitical risk reshapes the landscape for everyone, but foresight, flexibility, and strategic planning, combined with innovative insurance solutions, can turn uncertainty into an opportunity to build resilience. Staying proactive and informed is the key to navigating this unpredictable world with confidence. Here at Insurance World TV, we'll continue to break down these complex forces, helping you make sense of a rapidly changing risk landscape. If you found this episode insightful, share, and subscribe, and let us know in the comments which geopolitical risk you're most concerned about. Knowledge is your first line of defense.